7 months have passed in 2025. Have you even asked your financial advisor what the best ETF to invest in 2025 is? After analyzing a little over 170 ETFs and watching how the market has evolved, I've identified not just one, but 3 ETFs that fall under the Best ETF to Invest in 2025 category. These aren't the sexy, hyped-up funds you see on financial TV. But if you had invested in them just 10 years ago, you'd have outperformed 98% of professional money managers today while paying 30 times less in fees. So if you're tired of watching your portfolio go sideways while inflation eats away at your savings, or if you're just starting out and feel overwhelmed by thousands of investment options, this might be the most important video you watch this year. So, why are these 3 ETFs so powerful? It all comes down to a shocking reality that Wall Street doesn't want you to know. 89% of actively managed mutual funds fail to beat the market over 20 years. Think about that for a second. These are funds run by Harvard MBAs, teams of analysts, and managers making millions per year, and nearly 9 out of 10 of them can't even match what a simple computer program tracking an index can do. But here's where things get interesting. While these expensive fund managers are failing their investors, there has been a quiet revolution happening in the investment world. ETFs, exchange-traded funds, have been growing explosively, and for good reason. When you buy an ETF, you're essentially buying a tiny slice of hundreds or even thousands of companies all at once, instantly diversifying your risk while paying fees that are often 10 times lower than traditional mutual funds. Warren Buffett, who's made more money in the stock market than probably anyone alive, has been incredibly clear about this. He said that for 90% of people, the best ETF to invest in is a simple S&P 500 index fund. In fact, when asked what his wife should do with money after he dies, his answer was simple: put it all in low-cost S&P 500 ETFs. But here's what Buffett doesn't tell you in those interviews, and what I discovered after digging deep into the data. While the S&P 500 is great, there's actually a more sophisticated approach using the 3-fund strategy that can potentially generate even better returns while managing risk more effectively. But before I reveal these 3 funds, we need to understand why 2025 specifically creates the perfect storm for this approach, because the market landscape has shifted dramatically this year. First, we're seeing record ETF adoption. ETFs pulled in over $100 billion in net inflows just in January alone, with the Vanguard S&P 500 ETF ticker VOO leading the charge and becoming the single largest ETF in the world. But here's what's really interesting. Actively managed ETFs are now accounting for 34% of all ETF flows, with some experts saying actively managed ETFs are taking over the marketplace. Second, we're likely entering a period of increased market volatility. With concerns about tariffs, trade tensions, and Federal Reserve policy shifts, having a balanced approach between growth and defensive income provides stability during uncertain times. Third, dividend-paying stocks have become increasingly attractive as bond yields remain elevated but uncertain. Quality dividend growers give you inflation protection that bonds simply can't match. And finally, small and mid-cap stocks could finally have their moment. After years of large-cap dominance, many analysts believe smaller companies are positioned for a potential revival in 2025, especially if economic growth remains resilient. But perhaps most importantly, the fee advantage of ETFs over traditional mutual funds has never been more crucial. With average mutual fund fees still around 1.1% while these ETFs charge 0.03 to 0.06%, you're getting professional portfolio management at a fraction of the cost. So now that you understand why 2025 is the perfect year for the strategy, let me show you the 3 best ETF to invest in 2025 that make it work. So the first ETF in what I consider the best ETF to invest in 2025 strategy is VOO, the Vanguard S&P 500 ETF. This fund tracks the S&P 500 and gives you ownership in America's 500 largest companies, everything from Apple and Microsoft to Walmart and Coca-Cola. What makes VOO the foundation of the best ETF to invest in 2025 strategy? The numbers speak for themselves. VOO has an expense ratio of just 0.03%, meaning you pay only $3 per year for every $10,000 invested. To put that in perspective, that's 30 times cheaper than the average mutual fund. But VOO isn't just cheap, it's been incredibly effective. VOO has become the single largest ETF in the world and is dominating flow charts with $60 billion in net inflows year-to-date, reaching more than $680 billion in total assets. When you own VOO, you're essentially buying a piece of the entire American economy. Here's what's fascinating about 2025 specifically. While many experts are worried about market concentration in tech stocks, VOO actually provides the perfect hedge against that concern. Yes, it holds major tech companies like Nvidia, 7.33%, Microsoft, 7.04%, and Apple, 5.83%. But it also gives you exposure to healthcare giants, financial institutions, consumer staples, and energy companies. And there's something else most investors don't realize about VOO that makes it particularly attractive as the best ETF to invest in 2025. Unlike actively managed funds, where a manager might panic and sell during market downturns, VOO mechanically holds its positions. During the 2020 crash, the 2022 tech sell-off, and even during the recent tariff-induced volatility in early 2025, VOO just kept buying more shares as prices fell. This forced discipline is actually a feature, not a bug. The math on VOO is simple but profound. Over the past 15 years, the S&P 500 has averaged about 11% annual returns. Even if we assume more modest 9% returns going forward, $500 per month invested in VOO starting today could grow to over $1.2 million in 30 years. But that's just the foundation of our 3 ETF strategy. Before I reveal the second and third ETFs that complete the best ETF to invest in, here's a quick heads up. After I explain the next 2 ETFs, I'll give you 2 advanced techniques that could potentially add 2 to 3% to your annual returns. The first is a rebalancing strategy that takes advantage of market volatility to systematically buy low and sell high. The second is a tax optimization technique that could save you thousands in taxes every year while boosting your compound returns. So, do not exit the video right after the explanation for the third ETF is done. You could leave a lot of money on the table. Alright, the second ETF on our list is VTI, the Vanguard Total Stock Market ETF. Here's what makes VTI potentially the best ETF to invest in 2025 for many investors. While VOO gives you the 500 largest U.S. companies, VTI tracks the entire U.S. stock market with 36 15-plus companies, including all of VOO's holdings plus thousands of mid-cap and small-cap companies. Think of it as VOO plus a bonus layer of diversification. But here's the fascinating part that most financial advisors won't tell you. Both VTI and VOO have identical expense ratios of 0.03%, so you're getting significantly more diversification for exactly the same cost. It's like getting a luxury car for the price of a standard model. Now you might be thinking, if VTI includes everything VOO has plus more companies, why wouldn't everyone just buy VTI? Well, there's a subtle but important trade-off. VOO has historically had slightly better returns in recent years because large-cap stocks have outperformed small and mid-cap stocks. But here's why 2025 might be different. With the Federal Reserve cutting interest rates, small-cap stocks that are more sensitive to borrowing costs could be set for a new leg higher. Small companies typically carry more debt relative to their size, so when interest rates fall, their borrowing costs decrease more dramatically than large companies. This is why many analysts believe small caps could outperform in 2025. VTI's one-year return has been 22.79% with a 5-year return of 14.48%, and its broader diversification means it's less dependent on the continued dominance of mega-cap tech stocks. If we see any rotation away from the largest companies, which many market strategists expect in 2025, VTI could significantly outperform VOO. For most investors building the best ETF to invest in a 2025 portfolio, I'd actually lean toward VTI over VOO. You're getting every company that makes VOO great, plus exposure to the next generation of companies that could become tomorrow's Apple or Microsoft. But now, let me show you the third ETF that could potentially supercharge your returns. The third and final piece of the best ETF to invest in 2025 is where things get really interesting, because this ETF solves a problem that most investors don't even realize they have. Meet SCHD, the Schwab U.S. Dividend Equity ETF, and here's why it might be the secret weapon in the best ETF to invest in 2025 category. While VOO and VTI give you broad market exposure, SCHD solves a critical problem. It gives you income today while you're building wealth for tomorrow. SCHD currently yields 3.77 to 3.81%, paying dividends quarterly, which means if you invest $10,000, you're collecting roughly $380 per year in dividends that you can either reinvest or use as income. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which selects companies based on fundamental strength relative to their peers, and requires a long track record of consistently paying dividends. This methodology screens out companies that might have artificially high yields due to falling stock prices or unsustainable dividend policies. But here's the data that makes SCHD potentially the best ETF to invest in 2025 for income-focused investors. SCHD has delivered almost 60% returns over the past 5 years while being significantly less volatile than the S&P 500. Most importantly, during the brutal 2022 market crash, SCHD only lost about 7% while the S&P 500 dropped almost 20% and the Nasdaq plummeted 33%. This is where SCHD becomes incredibly powerful for 2025 specifically. With ongoing concerns about inflation, potential recession, and market volatility, SCHD offers what I call defensive income. You're getting paid to wait while owning companies that have proven they can generate consistent cash flows through multiple economic cycles. SCHD has attracted massive flows, with $13.32 billion in net inflows over the past year alone, showing that sophisticated investors are recognizing the value of combining income with lower volatility. And here's the mathematical advantage most investors miss. When you're collecting 3.8% in dividends while your principal potentially grows at 8 to 10% annually, you're looking at total returns that could exceed 12% per year. But unlike pure growth strategies, a significant portion of your return comes from cash dividends rather than just stock price appreciation. So now you have the 3 ETFs that form the best ETF to invest in 2025 strategy. VTI for total market exposure, VOO as an alternative foundation option, and SCHD for defensive income. But how do you actually allocate between them? Here's the sophisticated approach that most financial advisors charge thousands to explain. Your allocation should depend on your age, risk tolerance, and income needs. But there's a simple framework that works for most investors. For someone in their 20s or 30s who won't need the money for decades, I'd suggest 70% VTI and 30% SCHD. This gives you maximum growth potential while building an income stream that compounds over time. For someone in their 40s or early 50s, consider 60% VTI, 40% SCHD. You're still focused on growth, but you're building more stability and income as you approach retirement. For someone within 10 years of retirement, 50% VTI and 50% SCHD provides balance between continued growth and defensive positioning. The SCHD dividends can start to provide meaningful income, while VTI gives you inflation protection. But here's the advanced strategy that I mentioned earlier, rebalancing. Let's say your target is 60% VTI and 40% SCHD. Over time, if VTI outperforms, you might drift to 65% VTI and 35% SCHD. By rebalancing quarterly, selling some VTI and buying more SCHD, you're systematically selling high and buying low. This disciplined approach can add 0.5 to 1% to your annual returns. The second advanced technique involves tax optimization, and this is where the best ETF to invest in 2025 strategy shines. Unlike mutual funds, ETFs are incredibly tax efficient because of their unique structure. Here's the tax efficiency advantage that makes these the best ETFs to invest in 2025. In 2023, just 2.5% of all ETFs distributed capital gains compared to 31.5% of mutual funds. This means ETFs allow you to defer taxes until you actually sell, letting more of your money compound over time. ETFs use a unique in-kind creation and redemption mechanism that allows them to distribute significantly fewer capital gains to shareholders than mutual funds. When other investors sell their ETF shares, it doesn't create taxable events for you, unlike with mutual funds, where everyone shares the tax burden of other investors' decisions. For someone in the 24% tax bracket, this tax efficiency could save you thousands of dollars annually. The median tax cost ratio for the typical large blend fund was 1.61%, meaning investors in the highest tax bracket ceded about 13% of their returns to taxes over a decade. With tax-efficient ETFs like VOO, VTI, and SCHD, you could potentially cut that tax drag in half or more. Here's the advanced strategy. Hold these ETFs in taxable accounts while using your 401k and IRA space for less tax-efficient investments. Since SCHD's dividends qualify for preferential tax treatment at 0%, 15%, or 20% depending on your income, you're getting tax-advantaged income even in a taxable account. So here's a story that perfectly illustrates why most people fail at building wealth through investing. A colleague of mine, let's call him David, came to me last year frustrated because his portfolio hadn't grown much despite putting money in every month for 5 years. When I looked at his account, I immediately saw the problem. David was paying his financial advisor 1.2% annually to manage his money, Plus the advisor was putting him in actively managed mutual funds that charged another 0.8% in fees. So David was paying 2% per year in total fees. That might not sound like much, but here's the math that will shock you. Let's say David invested $100,000 and added $10,000 every year for 30 years. With a 9% annual return before fees, he should end up with about $2.3 million. But with those 2% annual fees, his actual return drops to 7%, and he ends up with just $1.5 million. Those fees cost him $800,000 over 30 years. $800,000! But here's what's even more shocking. The average equity mutual fund charges about 1.1% annually, while the average ETF expense ratio is only 0.48% for active ETFs and as low as 0.03% for index ETFs. This brings us to a crucial point that most financial advisors won't tell you. The biggest predictor of your investment success isn't picking the perfect stock or timing the market. It's minimizing fees while maintaining broad diversification. And that's exactly what these 3 ETFs accomplish. I'm Andrew, and I'll see you in the next one.